Options Made Simple, Part 2, Understanding Option Pricing. If you've not listened to Part 1, go back and listen to it. Caveat we always give when we do this kind of training that you've just got to understand. If you cannot read charts and make successful practice trades using shares of ETFs or stocks, you're just not ready for options. You need to spend your time understanding technical analysis, that is charting, and get good at doing simple practice trades using your weekly vertical crossovers, using your 2-day crossovers, using your pullbacks and your 4-hour crossovers. Get all of that down before you start spending time and energy on options. Why? Because if you don't do that, you're just not going to know how the market is moving, and you're wasting your time practicing options because you're just going to get killed. And you know what you're going to convince yourself of? I just can't do this. This just isn't for me. Well, it is for you. You just have to do it the right way. Now, let's jump back into where we left off from Part 1. We're going to talk about in, out, and at the money options. An option is in the money if it has intrinsic value. Now, you remember us talking about the various values. Intrinsic value is strike price in regards to the value of the security. Extrinsic value is the other things like implied volatility, days left until expiration of the option itself, because remember, options, they go bad, they disappear, they're a contract. You don't have any ownership. And of course, commissions. That's where our pricing models come in. But understanding in the money options, an option's in the money if it has intrinsic value. For call options, the security has a higher a higher price than the strike price. Now think about that. You're in the money because you want the stock to do what? If you have a call option, go up, or the ETF. And if it goes up in value, the more it goes up in value, that prior example we used of the fictitious XYZ Corporation, you have a $100 strike price that you buy when you purchase the option out in time, we'll just say 5 months. And during that time period, at some point, XYZ stock goes up to $110. Now your strike price is $100. How much in the money are you if it goes up to 110? Well, you're $10 in the money because you can actually buy, you have the right, and the way the option's valued is to buy the underlying security at $100. And if it goes up to $110, you are $10 in the money. Conversely, put options, if they go down, same example, you buy the $100 strike price for a put option on XYZ Corporation, expecting it to go down over the next, we'll say 5 months. That's the time that you bought in your option. And you can buy any number of time periods. The longer out in time, the more time you have to have it go in the right direction for you that you've determined because you can read a chart. So if it goes down, this is a put option. If it goes down to a lower price, we'll say from $100 to $90, you are thereby $10 in the money because you have the ability to sell the underlying security at a set price. That set price is the strike price of $100. So you're $10 in the money. Now, when you try to think that through, what does that mean? That means you could literally sell it for $100, buy it back at $90, and you have $10 in your pocket. That's the way you think that through. Now, options are out of the money if they have no intrinsic value, and actually the lower the value of the option, the more out of the money you are. For example, you buy a call option because you expect the security to go up. It goes lower. We'll use $90 and you buy the $100 strike price and it goes down to $90. Well, guess what? You're $10 out of the money. Out of the money by $10. The opposite is true with the put option. If the price goes higher, that $100 put option, the security goes up to $110, you're $10 out of the money. Now, an option is at the money if it has the same value as the security, and that typically happens for just moments in time, not anything to really focus on, but you need to know the term. Somebody says it's at the money, that means the strike price and the value of the security are the same. Now, what should you buy when you're looking to practice trade options? In, out, or at the money options? Well, understand, in the money options, you have a higher delta. What is a delta? Well, we explain that at the bottom of our graphic here. The measure of how much an option's price will change based on the value of the underlying security. So when you have an in-the-money option that you purchase, you have a higher delta. That means it moves closer to the price of the security. Security goes up $2. Depending on your delta, the higher your delta is, the closer the option value will mimic the price of the security increase or decrease. It's safer. In the money options are, of course, safer because you've already got value when you go in. They're more costly because, again, you're paying for that value that they have intrinsically in them when you purchase them. Less profit potential, but they also have less time decay because, again, they're in the money. They have value. Now, out of the money options, they have a lower delta, which means they move slower than the price of the security. But when they move, they can move really nicely in the right direction or the wrong direction. But again, if you have the ability to follow the charts correctly and are good at practice trading, this is going to be so much easier for you to get good at practice trading options. They are riskier. They're less costly, though. That's an important thing to note. And again, the more you know about what you're doing, the better that sounds. More profit potential, because again, when they move, they really move, and more time decay. Now, when we look at options quote sheets, option chains, you can find these all over the internet, all sorts of sites. You can just put in option chain and then put in when you find a site offering that, even the NASDAQ has their own, they're all over the place. You want to put in the symbol, you put in calls and puts, and then you can see in a snapshot in time. The snapshot in time here was a quote 11/10/19. That's the date, that's the time. Now these things are updated constantly. Why? Because price is changing constantly. And you can see strike prices in the middle column in the gray, and then you can look to the right and you will see puts. The left, you will see calls. And what's interesting is, and I really encourage you to call up some of these sheets and go through the option chains or the option montages, you'll hear them called, and look and understand what's going on and what's being presented to you. You will see things like the light blue area is in the money. The white area is out of the money. Those are important things for you to see and for you to understand. And look at the price. The last price, when this quote sheet was called up and copied, the last price on it was $308.94. So we go right there between 308, 309, and we can see the division. We can see on the puts, everything below that's in the money. We can see on the calls, everything above that is in the money on the calls. And you can see the pricing, the bid and the ask. And always remember, when you're buying something, you're going to pay the higher price. Even if you can't remember the difference between bid and ask, if you're buying it, it's going to cost you, if you're going to buy the strike price of $304, you're going to, and again, this is March of 2020, so it's out in time because this was November when we printed out the quote sheet. It's going to cost you $13.91 for the option contract. And you could turn right around and sell it for $13.79. So again, that's the sell when you get ready to actually sell your option contract. But that's just right now. Now, over time, of course, what do you want the call to do? You want the value of the call to go up. In other words, you want the price of the security to go from $308.95 to something higher. That's important. That's the whole reason you're buying a call, is because you've read the charts and you can tell which direction the trend is going, And that's what you are purchasing the option for, it going up if you buy a call. The opposite if it's going down. So again, important to understand. I encourage you to go out there, find some quote sheets, start looking at them. If you have any of the online websites that will allow you to do practice trading, such as like Thinkorswim, any of those, you can call up these option sheets also and practice trade directly from there. And again, important for you to see what these things are all about, to understand them, and to spend a little bit of time doing that, because when we come back with the next part in this series, we're going to really jump into how you purchase, how you trade options, how you practice trade them. Remember, we're not a stock calling service, we're an education firm, but we want you to understand how to do this, practice trade this, see that you are good at it, and stay with it. It is fun, it is exciting, it has all sorts of potentials for you, but it takes some work, and it takes dedication, and it takes your time and energy, and we're here to do all we can to help you all along the way. God bless. All the best from the whole team at Charting Wealth World Headquarters.